Good evening, everyone. Time for another silver update. This is the 30-minute chart of silver provided by netdenia.com. You can click on the link below. I've drawn a descending short-term trend line and an ascending short-term trend line. You can see we're tightening in this range. The price has stabilized at a lower level, so it's looking to try to test this really important 31 level down here, which is met at a number of points. And that's, if we do get a test and breach of that, we may get a little run to the downside. So that may present a very good stacking opportunity. We're just watching the price really closely. Now, the stock market, I expected a sell-off today based on the close, and you can see that the Dow actually had a bounce off of the lows, somewhat of a rally. You can see we're rounding off now and coming down. If we pull back a little bit and draw in the trend line comes from right about here at the top, and we're just about touching that line. So tomorrow is going to tell us whether or not we break through and start to rally again, or whether this decline continues. The action in silver and gold was kind of counterintuitive. With the rally, they kind of stabilized, so that was a little bit strange. The Apple chart, we've been watching this very closely, and it seems to be in a topping pattern, but you can never say for sure, because when these overbought momentum stocks, when they're in their final blow-off stage, they can go much, much higher than you'd ever expect. The other stock that I want to look at here, and I'm going to examine this later in the main story of the night, is Priceline. This is another tremendous bubble stock. When we pull out to the daily, you can see the tremendous rise in this stock. It's had a very sharp sell-off here. Of course, it's in what could only be described as a parabolic spike. If we look at the long term, this is the weekly, and we're going to revisit this when we get to the main story. So let's jump over to the question of the night, and this is from Celine42. Why do we borrow from China? Hey, Brother John, awesome work with the site, and I love your videos. Keep them coming. I do not understand why we borrow money from China if the Fed will purchase our treasury bonds and loan us money. Can you please explain why we need China's money and not just deal with the Fed? Thank you. Well, the relationship between the United States and China has been a fairly complex one. The Chinese have pegged or had pegged their currency to the US dollar. So because of that peg, inflation in the United States translates into China, and it prevents any type of currency advantage. When the Chinese have that type of a peg, you no matter what the dollar does, then the Chinese currency is going to do the same thing. Now, let's go over and look at that currency real quick, and we'll go into one of the cross rates and choose the Chinese currency. So the Chinese dollar versus the US dollar. Now, for the longest time, it was in kind of a peg. You can see that here. This is the peg period where you pretty much had an 8-to-1 ratio. Then through various pressure and political pressure, you had the Chinese loosen their currency into a expanding band, and you can see that the Chinese currency has gained not a significant amount of value over this period of time, because you're talking about 2006, 2012, a 6-year period, from about 8.3 to about 6.3, so we'll just say 25%. So basically the Chinese currency has gained about 25% on the US dollar. That's not going to be enough to have a very large impact, but it is gaining value. I fully expect, as I answered another viewer earlier on the blog, I fully expect that the Chinese currency will eventually trade at 1 to 1 with the US dollar and eventually surpass that. Now, that's going to present a tremendous investment opportunity if you believe the story. If you can get into the position of investing in that, one of the great investments would be, say, investing in yuan or renminbi denominated bonds in, say, Hong Kong or in any of the other markets where you can get those. You're going to get that Chinese interest rate, which will be anywhere between 5 and 10%, probably for the foreseeable future. Plus, you'll also gain the currency appreciation if this story plays out. So that could be a very good investment. But back to the question, the reason why the United States borrows so much money from China, it's really not a matter of us having to borrow from China, but more so that the Chinese, because of the peg that they've had, run continuous trade surpluses with the United States. In other words, China exports manufactured goods which the United States purchases, and China ends up piling up a large amount of dollars because of the continuous trade deficit we have with them. So just as you have petrodollar recycling in the OPEC nations, you have a sort of manufactured dollar recycling going on with China. So China has a whole bunch of dollars that they pile up because of the trade deficit, and they have to invest those in something. And they haven't done what the Japanese did earlier on and go into real estate, but they just purchase our treasury bonds, and pretty much they just get more dollars for their dollars. Now the Chinese are starting to back out of that, and they've definitely decreased their purchase, and I think they're trying to diversify their dollars out into hard assets, but they have a very large position in our bonds, so it's not in their interest to crash our bond market. They want to kind of slowly exit that position. Now, as far as the Fed buying bonds, that is an unprecedented situation. Traditionally, the Federal Reserve simply manipulates interest rates, normally just on the short end. With Operation Twist, we've had the Federal Reserve now manipulating interest rates on the long end. That is an unprecedented situation, and that's called quantitative easing, where the Fed is actually directly buying the treasury bonds, and that amounts to printing money. That is something that is new and that has only happened since the 2008 financial crisis. Could the Fed buy all the bonds? Yes, they could. In fact, some have suggested, why are we even paying any taxes? Why don't we just have the Fed print the money and buy all our debt? And of course, those things always end in disaster because there's no free lunch, there's no money tree. You can't just simply print money to pay for things. You actually have to produce wealth. And we addressed that yesterday, and I had some people question my pronouncement that the United States is worse than a socialist nation. Now, I want to clarify that a little bit. The reason why I said that, now some people said, well, we are a socialist nation. Well, I agree in part that we are essentially socialist. The problem is that we don't admit that we are. And since we don't admit that we are, that means that we don't have to do any kind of analysis of where that money goes, whether it goes to productive things or not. So most of that money just goes to services, and many of those services are anti-productive. And for that reason, I say that we're actually worse than socialists, because socialists have to actually look and see if the money is doing something valuable for their country, as opposed to just digging a hole and filling it back up. So that's that issue. Now, I wanted to take you to the main story of the night, and that's going to be how Wall Street loots Main Street I think the famous saying is that the stock market is basically a transfer of wealth from Main Street to Wall Street. Now, I wanted to use this Priceline stock to demonstrate that. We're on the monthly chart. If you remember in the .com situation, you can see here on the chart that Priceline actually ran up to almost $950 a share, subsequently crashing down to about $6 a share. And now Priceline has run up again to nearly $800 a share from that low of 6. So this is a very interesting stock because they're actually doing the same thing again. And I'm going to show you how the looting works. So let's go over to Priceline, and you can see this is the chart that we were looking at with NetDania. This is on Yahoo. The first thing we want to look at is the insider transactions. When we look at the insider transactions, you need to understand how the option writing game works on Wall Street. Basically, Wall Street rewards insiders through options, and this is a list of the sales of stock options and how they work. The main thing you have to keep in mind is that you can just look for any number of sales here. We're going to concentrate on the CEO here, which is Jeffrey Boyd. And what they do basically is they exercise their options at a low price. They're awarded these options as a part of their employment contract. You can see here, and now this goes back to May of 2010. So we're looking at roughly a 2-year period of the option transactions by this Jeffrey H. Boyd. And you can see here that we have an option exercise at $20. And the way you identify these is you can compare them with the number. They're not always exact, but you've got a good one here. You've got May 11th of 2010 where Jeffrey Boyd exercised 105,556 at $20 to $30, and then he sold at $500 to $531. So essentially we're talking about a net gain of about $500 a share. Now you can see the proceeds on this sale was $55 million. So I've added this up earlier, and over the course of just this period, this CEO has sold approximately $140 million worth of stock. He paid just a small percentage of that, so we're probably talking about a net of roughly $120 to $130 million. So here is this is just one person. This is a CEO, and you can see he still has 211,000 shares outstanding. So he's still got some selling to do, but he's done some major selling in the past. And he's unloaded his shares, which the company gave him essentially for free, and he's made about $130 million gain on that. Now, what's interesting is when we go over and look at the major holders, if you click on the list of major holders, this will give you, this is also required to be reported by the SEC. So I'm not going to fault the SEC in this because all of this is public information and the public continues to participate. So you can see here, here's your top institutional holders of this Priceline stock. Now, what's really telling is here are your top three with 9%, 4.5%, and 4%. So you're talking about nearly a fifth to a quarter of all of the stock of this company is owned by T. Rowe Price, Fidelity, and Vanguard. Now, what are those companies? Those are the companies that manage your 401k retirement. You can see them down here under top mutual fund holders. So what is going on here is that The U.S. government, via the 401k laws, which rewards employers and employees for investing in stocks. Primarily, most of these plans allow you to invest in stocks, and they match and they encourage you to invest in these. So the retirements of the people who have their monies in T. Rowe Price, Fidelity, and Vanguard, they are taking their retirement monies and purchasing the shares of Priceline, and then they are being unloaded upon by the insiders of the company, who are taking, as I showed you, just this one person has taken $150 million, $130 to $150 million roughly. If you add the others in, you'd probably come to $500 million or $1 billion. Now, if you look at the company, you can see that the market cap of this company right now is about $36 billion. But if you go all the way back to the bottom where it was roughly $6 in price, that's going to be 1/100th. So you're really talking about a $300 million company. So through the price appreciation of your retirement funds and the investment companies that invest your retirement funds, that has enabled the insiders on Wall Street to transfer the wealth of your retirement to themselves through stock options. That's how the game works. That's how it's always worked. That's what happened here when the stock fell from nearly $1,000 all the way down to $6. It's going to happen again, and there's no reason it shouldn't happen again, because people have never learned the lesson. So if you have your 401k invested in stocks and you don't really know what stocks you're investing in, but you're just allowing a mutual fund to invest your money, you're actually a participant and an enabler of this system where they transfer your retirement wealth to the insiders of these companies. So that's the way Wall Street has been. It's always been that way. It's just as bad now as it was during the dot-com bubble. I fully expect that Priceline will probably crash, as I expect Apple to crash. Now, I don't think that Priceline is a true value as Apple is, although Apple is tremendously overvalued. But I expect that Priceline will probably crash 90+% when this thing unravels, and then of course the insiders are going to waltz off into the sunset with their hundreds of millions of dollars, and you'll be left with a worthless stock in your retirement account. So that's how the transfer of money from Main Street to Wall Street works. It's always been that way. Jesse Livermore mentioned that it was that way in his day. Nothing has changed. The stock market is about taking money from investors and transferring it to insiders. So back to the chart. We are flatlining in silver, and we're waiting for a very nice stacking point. The last recommendation that I made for those who are into semi-numismatics, it's actually more of a halfway or pure numismatic play, were the half-ounce dragons that I picked up. A number of others have picked them up. They're out now as far as Gainesville and APMEX. You can still pick up a couple hundred at Provident, and I'm going to be watching those very closely to see if more come in. If not, that may become a very good semi-numismatic play. And we'll talk to you next time.